Okay, great. I think we're live. So good morning. And we have a terrific panel for you. Raul and David set us up really well for the things that we want to talk about. I have with me just an unbelievable cast panel. Tom Jessop from Fidelity, Tim Davis from Deloitte, Subhanker Sinha from BNY Mellon, and also Andrew Peel from Morgan Stanley. So we're going to get right into it. Maybe, Tim, if I could start with you, could you just talk about, when we talk about digital assets and institutions sort of coming in this adoption wave, when we say digital assets, what are we talking about? Is it Bitcoin? Is it non-fungible tokens? Is it something else?
Yeah, thanks, Jennifer. Yeah, I mean, digital assets is kind of broadly anything that's sort of controlled through a cryptographic means. So anything that is wrapped in a cryptographic wrapper takes on the definition broadly of digital assets. But really within that definition, you've got everything from NFTs to Bitcoins to other cryptocurrencies. So, you know, the definition itself, digital assets, is maybe not that helpful. But really what it means, as distinct from other things that are just digital, is this ability to control. So it's this sort of launch into trustless computing and everything that sort of sits on top of it. And, you know, I know we sort of talk a lot about sort of what's happening day to day in the news, but this is really, I think, the macro point here is that we're on the launch of a new era of trustless computing. And all of the finance innovation that's sitting on top of that is just one piece of it, a big piece, but one piece of really a change that's going to really transform the world in the years to come.
Excellent. Great. Well, so maybe we could talk about where we are now. And Andrew, I'm going to come to you on this first. Could you talk about the what you're doing at Morgan Stanley and what you're seeing from institutions currently? Are they exploring? Are they learning? Are they diving in? What do you see now?
Yeah, sure. So thank you. And I would say in terms of what we are doing, we did begin to start offering some of our wealth management clients access to Bitcoin and from a third-party fund earlier this year. And I think in general, just across the board, what we're hearing from more institutional clients, I think it's become increasingly more interest to learn. I think the varying different stages of development, it's often still those early discussions just to get really our opinion and an overview. But from some institutional clients, it's become more advanced. So it's moved on from that healthy dose of skepticism in 2016, 2017 and general education. I've had more detailed conversation around market structure, be it Bitcoin or Ethereum, but also specifications like onshore, offshore venues, physical versus cash settled derivatives, details on options, volatility, and the kind of specifics of options in crypto, even to the point of some conversations around proof of stake, consensus mechanisms, and proof of work, for example, in the comparison between those, and sometimes even DeFi. But the conversations have certainly evolved and got more detailed.
That's great. That's interesting. So Tom, what about you? Tell us about what you're doing at Fidelity and what do you see from institutions?
Sure. We've had an operating business in this space since 2019, roughly. And that business is effectively a custody and brokerage solution for family offices and other institutions that want to begin allocating to this asset class. About 6 months ago, we launched a small asset management initiative. So we offer private funds to institutions who are either uncomfortable dealing directly with digital assets or have some legal restriction from doing so. And in March, we filed with the SEC for a Bitcoin exchange-traded product. So we, maybe picking up on something that Tim said, we think that this technology is a central part of the next wave of financial innovation. Obviously, for Fidelity, as an organization serving the needs of thousands of institutions and other client types, it's important we get this right. And, we're seeing a lot of the same things that Andrew mentioned. We're seeing increased interest in allocating to Bitcoin specifically due to certain properties that have become more interesting in the wake of the pandemic and some of the fiscal and monetary stimulus we've been seeing. But increasingly, we're starting to see second and third wave interest, more clients interested in Ethereum, asking questions about tokenized securities, central bank digital currencies, which I think kind of proves our hypothesis at the outset, which is this is a new operating system for financial services. And once clients become conversant in some aspect of this, they start thinking about the implications for their portfolios and their businesses at large. For the second and third wave, assets now we're starting to see sort of Ethereum. So it's very exciting time to be in the market, and a wide range of conversations we're having with a wide range of institutions.
Yeah, very interesting. Well, Subhanker, what about you? What BNY's been in the news recently for sort of new initiatives related to digital assets, but what are you doing and what are you seeing from clients?
Yeah, absolutely. Thanks, Jennifer, and hi, everyone. I'm Subhanker, Director of Digital Assets and Blockchain within the Digital Asset Unit at BNY Mellon. And as Jennifer just mentioned, we launched the Digital Asset Unit early this year, but we have been working at it for more than 2 years now. So we have been listening to our clients. Across the enterprise, we feel it is imperative for us to actually meet our clients' growing and evolving needs for digital assets. What does it actually mean? Our clients want us to deliver secure infrastructure for issuing, transferring, safekeeping of all kinds of digital assets. And when I say all kinds of digital assets, there are broadly two types of digital assets. One is crypto assets, another is tokenized assets. Crypto assets are needed for running a blockchain network like Bitcoin, or to run a crypto native business, what I call the DeFi, a crypto native business. Tokenized assets, the assets exist in the real world, and we are tokenizing them, either financial asset or non-financial asset, tokenizing them on. So we are seeing broad interest from our clients for both types of digital assets for different reasons. For crypto assets, it's primarily driven by capturing a value in the network, whatever network it might be. For tokenized assets, the value drivers are different. It is for issuers want broader access of their assets, investor wants higher liquidity, utility of their assets. Service providers like us, we want operational efficiency improvement. Regulators want, more resilient financial market infrastructure. But there is a broad consensus among everyone about the benefits of digital assets. But we still have some work to do to actually get to the full adoption, and mostly in the infrastructure side. So that's at a very high level, Jennifer, what I'm seeing and what we are seeing.
Yeah, that's great. You're touching on things we're going to get to. But Tim, Deloitte's doing some interesting things here and a little different from the others. Can you talk about what you're doing and what you're seeing from clients?
Yeah, certainly, Jennifer. I mean, we are seeing a lot of clients that have got interest in terms of just how to get into the space, who to work with, but more importantly, wanting to understand what are some of the risks that we need to mitigate as we're acquiring digital assets, and really how to go about doing it. So, I mean, the controls that you need to have to make sure that you're not going to sort of lose or, do something you don't want to do with the crypto is important, but ultimately very solvable. So any of the institutions that are out there that are thinking, yeah, I'm not sure it's really for us, or I'm not really sure about how we would get into it, all of the accounting, the tax, the controls, absolutely solvable. And that should not be a reason for not getting into this space. And increasingly, the mechanisms by which the risks are mitigated are becoming a lot more user-friendly, I'll say. So that piece of it, I think, is very solvable. The choice of sort of who you end up working with and who you end up trusting as sort of being your custodian, that type of thing, is still an important decision to make. And there's a great variety in terms of choices, in terms of service providers in the market. So again, you do want to be thinking carefully about sort of not only where am I at today in terms of what I want to do, but thinking longer term, because this is very much a long game, not a short game. You want to be thinking about, okay, in 5-10 years time, this is what I want to be doing in the space, in the business. And is my chosen partner going to be able to sort of work with me to enable that?
Yeah, that's a great point. Great setup. Tom, maybe you could talk about what institutions actually want to be doing. What is their interest in digital assets? What do they want to accomplish in this space? What are you seeing from them?
Yeah, I think, if we, it clearly depends on the client, but if we were to just isolate, let's call it the investment case or the institutional interest in Bitcoin, which I think is sort of the gateway crypto, for lack of a better term, that's really brought a lot of institutions thinking about the longer term implications of the technology. There's a group of investors that would view Bitcoin as a network effect business model, similar to what we've seen coming out of, called the internet creation story in the late 90s. And so they see ownership of that asset as a way to generate asymmetric returns as adoption of this non-sovereign 24/7 value transfer network grows over time. There's another group of investors who have come to the fore, let's say in the past 15 months, which are interested in the scarcity value of Bitcoin, given the current macro environment. These are folks that are investing really behind this digital gold narrative, given the scarcity and other properties of Bitcoin. And then I think the third, and every time there's a bout of market volatility, there's a question mark over this group, but this notion that adding these assets to traditional portfolios provides a diversification benefit. And I think over long periods of time, you tend to see that because they're uncorrelated and the fundamental factors driving interest in those assets is different than what drives interest in stocks or bonds. And so that's probably a third category. And I think going forward, as there's more interest in other types of digital assets, those will roughly be the frames of reference for institutions that want to expand their remit in the space.
Got it. Interesting. Any other use cases that you're seeing? Any other, Andrew, anything you would add to that?
So in terms of interest, I think it's a good point in terms of the gateway to the cryptosphere, because Bitcoin has predominantly been that, in the sense that we talk about Bitcoin the asset, but as mentioned in the keynote and touched on by Tom, it's Bitcoin the network, and specifically Ethereum the network. If you think about the growth of the amount of transactions mentioned on the Ethereum network, and the fact that we've seen the likes of the European Investment Bank issuing bonds on production Ethereum network, you start to see some of the traditional finance world and the securitized assets actually being issued and transacted on public networks such as Ethereum, with the asset Ethereum required to actually access those networks.
Yeah, that's a great point, and Raul really focused on that, on the asymmetric returns, which Tom, you mentioned, but also Subhanker. Maybe you could comment on. Raul spent a lot of time on the exponential nature of these assets and the underlying networks and the volatility and other things that brings. But how do you specifically see that exponential nature playing out? Is there any sort of tangible example you can give us?
Yeah, sure. So I've been studying different digital assets on digital asset markets for a while to really understand what is different. And I see some very distinct different characteristics from the traditional markets in the digital market. For example, we all know near instant gross settlement. That really changes how we fund trades and so on and so forth. 24/7 market, no circuit breakers. So these are essentially the key tenets or key characteristics of digital asset market. What does it actually mean? So if we look at US M2 velocity, it turns over roughly 4 times a year. And if we look at a stable coin like USDC, which is at 20 billion market cap right now, although there is no comparison between the monetary base, M2 monetary base, and the USDC stablecoin market cap. But if we compare the velocity, one moves at annualized 4 times, another is moving at annualized 50 to 70 times. That is massive difference. Obviously, it's going to probably come down as the volume grows and so on and so forth. But it really signifies the difference between the traditional market asset velocity and the cash velocity in the traditional markets, with all the gates and freezing of assets and all that kind of stuff, to actually orderly conduct, what we call orderly conduct in the market, as opposed to in the digital asset market, where the market sentiment can take the market valuation to anywhere up or down. So that's really one significant difference. And as we see more and more traditional assets getting tokenized on these permissionless networks, like just Andrew mentioned, and Tom mentioned, then I start to think, will the traditional assets will actually behave like the crypto assets on this permissionless network? Will it actually move so fast? And will the regulators will actually allow the traditional assets to move so fast on the digital rails? To be seen.
Yeah, very interesting. Well, you mentioned a couple of times permissionless networks, and Tim, I was wondering if you could comment. You mentioned in some of your first remarks about digital assets that there are these trustless exchanges. This technology allows for trustless exchange. In your view, does that mean trust doesn't matter anymore? Is trust not a factor for institutional adoption?
No, yeah, it's a good point, Jennifer. Clearly it does matter. It matters probably essentially. But trustless is really, the term trustless means that we're not necessarily trusting counterparties, we're trusting the code and the machine. But inevitably, in any sort of practical relationship, we are working with other entities that are going to play various roles, and the trust that we have in those entities, be it a custodian, be it service providers, all kind of is absolutely essential. I would say, as we sort of think about trustless computing, there is still a lot of skepticism and I would say lack of trust about this whole system that's out there. And I sort of just go back to one example, if you just sort of allow me this by way of analogy, is when the horseless carriage came into existence, 1863. So this thing was polluting, it was unreliable, it didn't have regulation to guide it, and the horse owners that were driving that kind of criticism at the time, they were right. But what they failed to maybe understand when they saw that thing is that this scales. Yes, this only maybe does even less than one horse in terms of power, but it had the potential to really transform the world. So we're at that stage really now where crypto is not going away. This evolution of trustless computing is not going away. And it really doesn't almost matter how regulators approach it. I mean, it's only going to slow or accelerate the pace of adoption. But this is really the responsibility of both institutions and also the regulators in terms of how we're going to responsibly sort of wrap ourselves around and transform ourselves in terms of what we do around this new area of innovation, because it's coming whether we like it or not.
Yeah, absolutely. I love that. That's a great example. And maybe, Tom, could you comment your, its brand, I think, really does matter here for institutions, or at least that's what I hear when I talk to institutions. I think they're looking at your companies like Fidelity and all the companies represented here. I think that's where they'd like to be supported, for their digital asset investments or anything else they're trying to do.
Yeah, look, I think that for all the companies and institutions represented on this panel, I think in the abstract, while this asset class has some unique idiosyncrasies that need to be addressed, it's thinking about another asset class and adding it to an existing service framework, whether you're an institution or even a retail investor. And yes, I think that in terms of the first wave of adoption of this technology, that is a very familiar construct, right? We're an institution trying to bring a new asset class to our clients. We're not a small company trying to become an institution. Right. And so, and I'm sure my fellow panelists would speak to this as well. A lot of the approach we take as it relates to risk management, operational excellence, service provision, how we think about providing service to clients, is very much, in many ways, a very tried and true construct in other parts of our institutional business, right? There's nothing different that we're doing in crypto. We're trying to bring that same level of service. Where I think it starts to get interesting is how do we take all of these things that are unique and interesting about this new asset class and make sure we can expose those things to our clients in the best possible way. I think it would be quite disappointing if we didn't expose some of these capabilities, the programmability of smart contracts or things like staking and other things, and bring those to our clients for their benefit, and not quote unquote trying to re-centralize everything. Although I think it is part of the service provision aspect of that, I don't see that going away. I think our central case thesis is that while some people may want to avail themselves of the true decentralized nature of some of this technology, there's probably a greater number of people that want to see these assets sitting in the same type of risk portfolio and accounting construct as they do their mutual funds, their stocks, their bonds. And, that's sort of like the line we're going to try to walk as we move forward, finding that balance between the old and the new.
Yeah, interesting. Yeah, Andrew, you and I were talking about that a little bit. I think the existing very large companies have trusted brands and want to protect them, right? So I think have to balance, entry into this very new and nascent, immature asset class. Maybe you could comment on that a little bit.
No, absolutely. I mean, there was a recent survey published by Elwood and PwC, and they, as part of this quarterly, they brought in some of the comments from 40 different hedge funds, traditional hedge funds. And of the 40 that were surveyed, there were 80% which were not currently invested. And of those 80%, 25% were later stage planning or somehow thinking about looking to invest. And I think the main obstacles that came up there, which were highlighted as reasons to not have invested to this date, were certainly the classics in terms of regulatory clarity, reputational risk. It's a new asset class. There's obviously some headline risk and some traditionally bad press from traditional financial media. But it's also the current service provider availability. This space is new, it's evolving. This institutional access is just being built out by the likes of Tom and the team at BNY Mellon as well. And I think in addition to that, if you start to look a little at the last few weeks of price action, I mean, it was really significant in terms of crypto standards. I mean, we've seen obviously percentage drawdowns of the crypto market both in 2013 and 2017. And people think it's a feature, not a bug. But then you start to look at the notional sizes traded and the market caps these things are drawing down. It's very different than it was back then. We dropped from 2.5 trillion total market cap in crypto just around 2 weeks ago by over $1 trillion. And to put that into perspective, back in 2017, the entire market cap was only 800 billion of all digital assets. So we're down by more recently than the entire market cap in 2017. And whilst it's definitely attractive for some participants and some clients, especially in these exponential growth markets, it's seen as a feature. Some will see it as an opportunity, but other clients, I think, certainly those that are now thinking about accessing the space would like to be cautious, and they would like to probably be exposed to counterparties with significant balance sheets, liquidity, due to a lot of these different natures of the asset class mentioned, pre-funding, having to have assets at each individual venue and custodian in order to be able to trade.
Yeah, that's a really great point. And so Raul touched on that too, the kind of different structure of this market and how in that drawdown that you just mentioned, nothing really broke. There were some exchanges that weren't available for a short time, but there were no systemic, sort of failures. But maybe I think, Tom, maybe you could comment on that market structure difference, some of those differences. If I'm an institution coming into this space from a traditional asset classes, what are some of the differences I'm going to encounter when I come into digital assets?
Yeah, I'd say the first thing, and Andrew spoke to this, is the recognition that this innovation started as a retail phenomenon and then it moved institutional. So there's still a lot of retail participation. As we saw with some of these Asian derivatives exchanges, you get these very speculative manias that are driven by leverage, and then the bubble pops. And there's been many examples of digital assets correcting 30 to 50% on their way to much higher numbers. It's just I don't want to use the term feature, but it's a feature of the industry. And so clearly that's one aspect. The other aspect is that it's truly a global marketplace. I mean, in some respects, it looks like foreign exchange. We saw over the weekend, big moves over the weekend when folks in the US are asleep, and that's something to keep in mind. The related concept is there's no central tape. You need to aggregate data from a number of exchanges. Not every exchange where you see significant price discovery is accessible to certain investors depending on their jurisdiction, so it can be fragmented at times. Historically, things were pre-funded. You could not really get margin from a broker or market access or like prime services. That's changing, but early adopters had to open accounts on multiple exchanges and leave assets there to avail themselves of best price to the extent it was on one exchange versus another. The last thing I would say is there's still a big over-the-counter component in the spot market and certainly in the derivatives market. So it's more of a hybrid than some of the other exchanges we see that are either firmly OTC or firmly central limit order book. The good news of all this is that there are a number of service providers that are starting to weave these threads together into something resembling an institutional experience. And you've seen that going back to Andrew's data point around 17. And what happened in the last drawdown, spot volumes are up significantly. Spreads are much, much tighter. We follow this on a very consistent basis. Spreads are much, much tighter than they were back then. Even over the course of the past year, they've come in quite a bit. There's more liquidity in the market. We have listed CME futures. So I think that the markets are evolving quickly and the service provision is evolving quickly in the direction of being able to serve the needs of traditional institutions. It will be bumpy and it will be different, but it is a lot less bumpy and a lot less different than it was 4 years ago.
Yeah, well, interesting. I think at the very end, David asked Raul if the most recent volatility in the last 2 weeks that you, Andrew and Tom, you've both been talking about, would it discourage institutional investors? And I'm wondering maybe if any of you, maybe Subhanker, could start with you. Have you seen any of that? Did you hear from institutions in the last week or two? Do you think it dampens interest from institutional investors?
No, I personally have not heard any change of plan from any of our clients, but that does not mean that our clients are not thinking about or looking at this market. But one thing I would like to point out, a couple of things. One is our clients are all institutions, large institutions who take a long view whenever they invest or whenever they choose to go into any market. So I would assume that they are doing their own research with respect to crypto assets and tokenized assets, and they're taking a very long view in order to create new products or to change their business or operating model using the assets. That's number one. The number two, I would say, is if we look at our existing market structure and all the products which have been built on top of that, whether it is pooled products or separately managed accounts or all other kinds of products, those are based on the assumptions of how the underlying markets actually work. So I mentioned about circuit breaker before. In the traditional exchanges, if something drops below 7%, there will be circuit breakers. And then if you have, I'll just take an example, if you have an ETF on top of that underlying asset, so there won't be a massive diversion between the ETF and the underlying asset. I personally, and I'm probably the least educated on this particular topic on this channel, but I can't reconcile between a pooled vehicle and an underlying asset which has no circuit breakers. And I just don't know how that traditional product innovation is going to apply on a market which is fundamentally different from a velocity perspective, from the sessions perspective, from the circuit breaker perspective, and all the other things. But that is not to say that we're not going to see innovation. I personally believe that we're going to see very fundamentally different kind of innovation in this particular market, as we have seen in the case of stablecoin. The innovators realized there is a real need, and stablecoin was innovated to actually settle trades in crypto assets in a real-time basis, whether it is weekend or after hours. And I think we're going to see similar innovation on the product side as well.
Yeah, interesting. That's a really good point. I think that sort of brings up the topic of decentralized finance, or DeFi. And Andrew, maybe you could comment on that. You brought up Ethereum before, so have others in this panel, and also Raul was very bullish on Ethereum, I think, for some of the reasons that Subhanker was just mentioning, the innovation. But maybe you could talk about that. What is decentralized finance? How do you think about it? And how should institutions be thinking about it?
So I think it's really early still, but exploding in terms of growth functionality, and the amount of assets which is involved in the space of DeFi. So if I look at simply Ethereum alone, so just talking about Ethereum, there's this whole entire new ecosystem being built out there, using the fact that Ethereum has this ability for composability, to reuse code and services that other developers have created on the network. It creates this really uncontrolled capitalism, innovation, growth of all these different connecting services. So I think pretty much any of the traditional financial services that you see out there in our world, in these traditional financial worlds, appears in some form of a smart contract, be it lending, borrowing, yield, decentralized exchanges, derivatives. I mean, the Ethereum network went from less than 1 billion last year to over 80 billion a few weeks ago, and roughly around 60 billion. So the innovation there it's fascinating space. I think it's key to understand, how you can not stifle that innovation, but try to harness it in a way that you can really make use of that. Because it's programmable money, if you will, the ability to automate all of these different tasks and processes that have traditionally required multiple people in back offices and various different services within traditional finance are now being developed as contracts on the blockchain such as Ethereum. Yeah,
interesting. Tim, I wonder if you could comment on that. All those capabilities that Andrew's mentioning also sound like things that can go wrong or may need to be controlled or audited or otherwise made assured that they're correct. How do you think about decentralized finance and what you're doing?
Yeah. Well, I agree with Andrew. I mean, it really is the essence of the purest form of capitalism. So it represents this amazing era of innovation. And I think, institutions are still struggling with how to. They want to get involved, but there's a number of questions. You raised some of them. Compliance with the travel rule is one key sticking point, because right now with the new FATF recommendations, I think even FATF is quite frankly struggling to sort of come up with a mechanism that's workable in terms of how do we get comfortable with the AML KYC risks around DeFi. So I'm confident with all of the thinking and the innovation that eventually we will see the best of DeFi come together with the best of institutional capital. Tom made this point that institutions right now, they want, the kind of parties that have that can give them some clarity on risk transfer, right? So either that is competency, or it's balance sheet, or it's insurance. But the insurance market is still, frothy and fragmented, but it's getting better, and I think these Lego pieces are coming together where it's an opportunity and quite frankly a risk for the insurance companies and the banks, right? To say, we have both the balance sheet and the ability to provide clear risk transfer. We're going to help provide that for you, and we're going to be the sort of experts in terms of how to manage that risk. That combined with all of the innovation that we're seeing in DeFi, I think really is starting to paint a picture for sort of where we're going in the future. I think we'll always have a sort of a non-institutional DeFi that just sort of is innovating in its own, and it's important that it does so. But this sort of enveloping of DeFi into the corporate world is a step that, I think some companies that we're talking to are beginning to think about how can we bring the best of DeFi within an institutional regulated space and take advantage of that.
Yeah, that's terrific. That sort of brings up a topic I wanted to come back to. Subhanker, you mentioned stablecoins. Tom, I wonder if you might spend a minute on central bank digital currencies. Why governments, just sort of what you're seeing. I think we see a lot of governments talking about them. Why are governments focused on central bank digital currencies? And I think that sort of brings up a whole tension with stable coins, which maybe we can get to after you sort of maybe talk a little bit about what central bank digital currencies are or hope to be.
Yeah, what I would say, generally speaking, and I'm sure others on the panel have more informed views than I do. I think that the Fed and other central banks are exploring this. This new monetary technology. How can you achieve certain policy objectives by using it. And so two examples, one in the institutional space might be the ability to have more instantaneous settlement for various types of transactions, trade, finance, what have you, by having a CBDC or a native digital dollar or pound or euro on the same network or proximate to some sort of financial asset, where that settlement can happen quickly and at low cost versus what happens through the traditional banking system. I think more on the consumer side, where I had heard this come to the fore, and actually I think it was raised in Congress briefly, this idea of distributing aid. So on the back of the pandemic, when the government was sending out support checks to people, is there a more efficient way to get that money in the hands of people that need it quickly, as opposed to doing it through the banking system, particularly for people that are underbanked or don't have access to financial services? So those are sort of the two primary, what I would say, at least in my mind, potential policy benefits might be. But then there are these questions, because you're touching upon the cryptosphere, so to speak, which is very focused on privacy and self-sovereign finance. Questions around, what does it mean for privacy? Will these transactions be as private as a cash transaction, for example, if I paid you $20 for something? That's where it starts to get interesting. But I would say that those are probably the two primary reasons that central banks are thinking about the utility of this technology as it relates to fiat money.
Yeah, I think Fed Governor Brainerd mentioned that specifically, I think, yesterday in a speech, that ability to get aid to citizens who are unbanked. And so I think that's absolutely right. But Governor also seemed to spend a lot of time think about stablecoins. That seems to be, the Fed seems to be signaling this, and I think our next panel will sort of touch more on this. But Andrew, I was wondering if you might comment on stablecoins. Why would governments potentially have concerns about stablecoins?
Well, I can understand when you start to see the sizes of the issuance of these stablecoins, be it Tether, which was recently, the reserves of Tether were recently made public, or be it even the growth of some of these other networks, such as USDC, which tens of billions of dollars operating on some of these networks, which they don't have the level of oversight, perhaps, that they do of the traditional issuance of dollars. And that's a fringe probably concern at the moment. But as these numbers start to increase, and they've been increasing significantly recently and continue to increase significantly, they start to become a topic to think about how these fit into the traditional financial ecosystem.
Yeah. We
saw, of course, the announcement just over a year ago now from the likes of Facebook offering their DM platform as well. That was an interesting topic, which brought Facebook in front of Congress for even, I think it was 2 days of hearings about DM and what they were planning to do with that particular network. So the thought for them of perhaps like a tech firm issuing a competitive basket of currencies to the US dollar must raise alarm bells, and then start to think, well, there must be something here to this technology based on just the facts that the use case has grown significantly and the volumes have grown significantly. We should evaluate what those use cases are and understand how we would fit in a new world where all assets are transferred and exchanged in a digital manner.
Yeah, that's a great point. It's interesting you brought up Facebook. I know, Tom, you brought up when we were talking before that social media seems to drive this space quite a bit, digital assets. And Twitter seems to be sort of the leading forum, or maybe some of the other newer ones like Discord and Telegram. But maybe are there people that you like to follow? Who's your sort of favorite Twitter handle that you like to follow for digital assets?
Yeah, I follow lots of folks. Obviously, Raul, the panelist on the last session, someone I follow pretty regularly. Lynn Alden is another person who's got some very interesting perspectives on the macro implications of the asset class. Folks like Peter Brandt, who is I guess a traditional market strategist technician, has a pretty neutral take on digital assets, which is refreshing because so much of crypto Twitter is obviously very, very pro crypto, which is great. and then just some other industry friends. It's quite a broad list that I follow.
Tim, what about you? Do you have favorites on Twitter?
I don't, but I tend to sort of listen to a lot of the different voices out there, and actually some of the voices that get a little less attention sometimes are actually some of the most interesting. Jennifer, one just quick comment on the CBDC point, which I do think we will see it as, and it will be a sort of the ultimate backstop, but the ultimate stable coin. And I think it's somewhat inevitable for the points that Tom and Andrew made. But if you think about really, this risk offset, at the moment in the crypto market, you have this you have to go all the way back to a stable coin, right? In terms of getting out of, some the beta that you're in. And ultimately, you can see the market wanting a greater choice of a risk gradient, right? They don't want to have to always go back to a stable coin. And so some of the innovation that Arca is doing here, where they're wrapping in crypto tokens, something that is regulated, that gives you a spread, that, with a 40 Act fund, I think really represents a tremendous innovation. I think we're going to see more of this, where investors have a greater set of options in terms of how they de-risk their positions. So anyway, I thought I would just mention that, but that's sort of what I see. I see a lot more richness and variety in terms of risk alternatives in the DeFi market coming.
Yeah, interesting. Yeah, I do think ARC is doing so many interesting things. That's why they're one of the people that I follow on Twitter for that reason. Since I have the four of you and you've been in this space for a long time, I'm going to ask the ultimate question that I think everybody wants to know the answer to, which is, since you all know a lot about this topic, who is Satoshi Nakamoto? Does anyone have that for us?
I would say it's thank goodness we don't know. It is one of the critical features of Bitcoin. So hopefully we will never know.
I think it's not Elon Musk. I think we could be going on that, but it could be one of 5 billion other people on the planet, I guess.
No, I agree. I thank goodness that we don't know, and I hope that we never find out, because we have the tendency to associate biases towards people and where they're coming from. The moment we would find out who that person is or who the group is, we will associate biases with the innovation and immediately try to find intent behind the innovation. And that would be probably one of the big blows to the innovation itself. Before I pass it on to you, Jennifer, just a couple of thoughts on the CBDC and the cash tokenization. So, the tokenization or the digitization cash is very, very important, and it's very relevant for our BNY Mellon and also for the industry as such. As I mentioned, the stablecoin was invented to settle trades in Bitcoin, and but the institutional adoption of cash tokenization. First of all, cash tokenization comes in very many variants. CBDC itself comes in many flavors: wholesale, retail, and so on and so forth. The political drivers, which Tom touched on different countries, are very different. Privacy concerns are very different. That drives the actual adoption of this. So, for example, CBDC in Singapore and CBDC in US will have very different political drivers, I would say. I'm just taking example. And also stablecoin, whether it is bank money or whether it is backed by some other reserve, has vast implications on how the usage of those tokens are going to be. So this space is extremely fast evolving, the cash tokenization space, and we are very focused on that particular area, and we are analyzing the innovations in that particular space because of what we do and how we help. So I would just leave it at that we cannot put even all the CBDCs in the same bucket, let alone all the stable coins. Some are bank backed, some are private companies backed, and so on and so forth. The counterparty credit risk is very different depending on who issued is. So I think this itself is going to be a topic for discussion for many months and years to come.
Yeah, I think it's so counterintuitive that in this space where, as Roel said, many people are coming into this space because of the asymmetric returns available, that CBDCs and stablecoins would be such a central topic and something that's, really focus of regulators and innovators. It's very, very not expected. Well, maybe my last question to all of you, maybe you could just briefly comment if there's one thing you'd like our audience to take away from this panel, and maybe Andrew, I could start with you. What would you like, maybe not maybe the only thing, but just one thing you think it would be important to take away?
That I guess traditional financial institutions are also very interested in the technology, not just the asset class, thinking how we can utilize that in traditional finance. Always open for learning and for making progress in this space. It's fascinating. Really enjoy being part of the industry, even from within traditional finance.
Wonderful. Tim, what about you? Any one thing you'd like people to take away?
Yeah, this industry is only going to continue to grow. So as you're thinking about whether or not you should be involved, the sooner the better, quite frankly, because even if it's aside from any sort of financial motivation return, just the learning itself is absolutely critical in terms of where you want to go next with this industry. So the longer you leave it, I think the harder it will be.
That's great. Subhanker, what about you? Any one thing?
Yeah, so I'm an infrastructure guy. So I look at the infrastructure being built, and I believe that the infrastructure has to be built before regulators get comfortable on product innovation. So if I'm looking at one thing is what infrastructure is being built to support the digital asset market, and that's my only suggestion, I would say.
Got it. All right. Well, Tom, you get the final word. What?
I think for me, I would just say don't underestimate the rate of change. I find it astonishing, and I think humans tend to underestimate. And going back to what Raul said earlier, it is exponential, the age we live in. And just a couple of data points. Through the first 4 years of the Bitcoin experiment, from the Genesis block to 4 years later, the market cap of Bitcoin was about $150 million. If you look at DeFi in the first DeFi protocol, which arguably was MakerDAO, 4 years later, we're at 65 billion in locked value. And then a fun reference, if we look at NFTs, the first NFT project on Ethereum, I believe, or at least the first one to get any type of recognition, was CryptoKitties back in 2017, which I think almost broke the Ethereum network. And 4 years later, we had a piece of digital art sell at auction for $60 million. And hundreds of millions, if not billions of dollars now going into private companies that are developing NFT capabilities. So it's only going to get more interesting from here. And I agree completely with Tim. If you're not involved in this space, you have to begin understanding what this is, because it will have significant impact on your business soon.
Awesome. Well, great. Well, I hope our audience watching will use Tom and Subhanker, Andrew and Tim as a resource, because they and their firms are a tremendous resource for the industry. Thanks to all of you, and thanks for a great panel.
Thank you.
Thank you.
Thank you.